Da, da, da. Where was I? View. Oh, hang on a second. Okay, got to share my desktop, and we should all be on in 1 second. Share desktop. There we go. Okay, so we should all be looking at my favorite screen, which is my thinkorswim active trader screen. And let me fix this thing. I gotta bring the chat box back up. All right. So let's see. Now today I really only have an hour, so we got to get some stuff done. Yeah, hold music would be a great idea. Whoever said that. Okay. So we had a little bit of fun this morning. We went long. It didn't last, but we went long over here early in the morning on TF off the 1170 line. We got a little bit of a pop. I made $340 on this particular one, and then it plunged. So we actually would have been better off going short, but didn't know that at the time. Or we would have been better off going long at 1160 again, because obviously that was a nice run. Then oil, we had a really good call on oil. Here we caught it coming up here from, what was it, 86 to 87.10. So 87.10 was our mark around the inventory report. Let me see if I can make that a little bigger. So coming into the 10:30 oil report, we called, we weren't getting 87.10 yet, so I called 87.10, so that's good enough. I figured that should hold. And it didn't quite. It fell, we fell on the inventory. You often get like what they call a head fake, where it goes the wrong way. So right at the inventory report, the oil spiked lower, and that was okay. I mean, for me, that's okay, because then, you know me, I just I just dollar cost average down a little bit, and then we got to move back up. So we got a nice low basis, but 87.10 worked, and it went right back to our goal, which was 87.75. See this line? All right, and what is that? That's, how did we know that was going to happen? Hang on, let me get back here a little bit. I'll show you what we said. If I can find my post for today. All right. It's stuck in my head. I can't remember what the name of the song is. All right. So it was okay, so we were talking about oil, and I said at the time, this was 10 o'clock, a little bit before the inventory report, and I said the expectations are, now see, here's the thing. Where is it? Do we have the API? Yeah, see, I put up the API report. It always really valuable on a Wednesday before the oil inventory is you have to look at the API report, because that sort of sets the expectations for this report. So what we saw in the API report was that inventories were up by 5.1 million barrels. All right, so this is telling you, it's not, by the way, this isn't accurate. It's very rare they actually get it right, but they got it right today. It's very rare they get it right, but these are the expectations that traders have going in. Even though it's hardly ever the right number, they still think the API is going to be right. So when you see oil move on a Tuesday night, it's usually moving because of the API report. Then you have to think how likely it's going to be that the API report actually matches the EIA report that comes out in 2:30. The EIA report is usually more accurate than the API. The API is just first of all, it's an oil industry report, so you're asking oil guys what they think the price of oil should be. And what happens with the API report is they sort of randomly call a bunch of guys who have warehouses of, who run storage facilities and whatever, and they say, hey, how much oil you got? How much gas you got? And they just jot it down. So it's like a pretty haphazard survey. That's why it doesn't work so well. EIA does a bit of a more official job with government accounting and so on and so forth, but only at a couple of places. They're not counting the whole country. It's mostly Cushing, Oklahoma. So either way, it's just only giving you a slice, and it's not accurate. But the idea is at least you know what the expectations are. So here we had 5.1 million barrels of draw on oil build on oil, and they thought gasoline went down a bit. They were wrong about that. And they had distillate fuels, and they thought that they went down too. So they thought distillates and oil offset it. So what do we find out? So I'm saying at 10 o'clock, based on the API report, they had expectations of low. So probably on gasoline, 230 would hold, but I didn't like that bet, which is a shame because it actually went well. Charts. See gasoline, so 230, whoa, that's the wrong place. So 230 we thought would hold, and it actually went flying up to 234. That turned out to have been a good bet, 230. But it went flying up there. But I said I'd rather bet because I felt more comfortable with going long on oil, which was 87.10, into the inventory. So it's just you have to realize how volatile it is at the inventory, though. It's not exactly the safest bet in the world. But and see, because of the 5% rule, it came down from 90. 2.5% below 90 is 87.75. So you expect that to be the line where you're going to hit resistance. Then you figure this is an overshoot. 3.3% is, a 2.5% move. What's an overshoot? An overshoot is 5%. Would be 5% would be half a point too strong, right? So that would be a week down. A week down is 0.5% when you come off 2.5%. So an overshoot is the same as week down. So you expect a 0.5% overshoot. So 3% is normal overshoot for a 2.5% move down. 3.3% is a strong overshoot to the downside, and probably that's going to fail to come back to the 2.5% line. All right, and I'll show you that in action here to make it a little more clear. Where did we go? Oh, yes, there. Okay. So hopefully you get what I'm talking about. But in other words, the big move is down from the 90 line, right? So from the 90 line, this was 87.10 was 3.3%. So it bounced off the 87 line. That's why I felt good about 87.10. I figured it wouldn't have too far to fall. And now I say bounce. It did spike down to 87.83. So if you're sitting on that, you're down $270 when it does that. You have to be prepared for that. That's going to happen. So it went down, spiked down in the wrong way, $270 at 10:15. But of course, getting in right before the oil report. See, with the inventory not out yet, I didn't mind that. And then it bounced back up, and then it gets right to the line we expected, 87.75. A little bit over, but like I say, again, this isn't science. It's not like physics where it's exactly going to do something. It's just going to go back around there. So 87.75 was right where we expected to, and it failed, which is also what we expected it to do. So we got out right exactly there and got a nice $760 profit on that swing. So that's a nice way to go. You have to look and wait for those you wait for the fat pitches. When you see something come in that's like so obvious, it's so likely to happen, you can wait for those fat pitches and swing. So right now there's nothing obvious going on except probably here, I'd say the Dow's not likely to get over 16.7. So you could play, and it just did anyway, you could play the rejection at 16.7. That's a tough line for it to break. And then to get out of your trade at 16.715. So I like the short here because what happens? It's already failed 16.7 multiple times, during the day. Okay? When it broke 16.7 and broke it hard over here, there's a support resistance line. The main support resistance line is right at 16.715. So I have a backstop. So at $5 per point per contract, $15 means I can only lose $75 per contract. But what can I win? If I'm right and it doesn't even get here and I don't stop out, I can go down from 16. I got a pretty clear shot to go from 16.7 to 16.550. That's 150. So I could make $750 on the short versus I'm risking losing $75 if I'm wrong about the trade. All right, is that clear? Does anybody hear this? Nobody's saying anything. I don't know if I'm just so entertaining, but okay. I like to get a little feedback sometimes, so I know somebody's on the other end. Anyway, so you understand that trade though? What I like is I want to find a trade where there's a line that I feel comfortable getting out at, where I think that, okay, so I have a good premise here. I think 16.7 isn't going to hold because it hasn't held all day. Okay, even when these guys look strong, and these guys look strong, everybody's looking good for a little while. It didn't make it to 16.7. That dropped like a rock. So since I've only got 15 points before I have a really strong, I'll call it 20 points for a $100 loss. If I really got 20 points before I really would take my loss and stop out, and if that's the case, then I have so much more to gain because there's not much resistance all the way down here, and that's a 150-point drop. So that's a good risk-reward entry, okay? Now, I'm saying this in absence of news, though. That's the other thing. Don't forget, in the oil trade, I'm just saying this because we happen to be having the seminar right this second, and we're looking right this second. So of the things I'm looking at, that's the best one. But that's in absence of me paying any attention at the moment to the news or anything. See, the reason we made the oil trade is because we knew there was an event coming. We knew there was an oil inventory coming at 10:30. We knew that the expectations were fairly bearish because the API report had bearish outlook. And so knowing those two things together, and we also went long on USO here. We took a long on USO. Knowing those two things together, there was a catalyst that gave us an immediate reason to do this move. Now, with the Dow, do I have an immediate reason to do this move? So let's go back to this is the wrong Monday, but let's go back here anyway. Monday, maybe. Okay. So we'll go back to Monday's post. See, we talk about a lot of stuff, but a lot of it's relevant. We talk about a lot of different things, but they kind of come up during the week. So Monday, what did I talk about? 12 Fed speeches in 5 days, right? So we talked about who's a hawk and who's a dove, blah, blah, blah. So what do we know? This is a roadmap to the market. It's 1 o'clock now, and Tarullo speaking, all right? And Tarullo is he is a medium kind of hawkish guy. Okay, so very hawkish guys, very dovish guys. He's a kind of middle-of-the-road guy. So not a big market mover, Tarullo. Well, it could be, because he could say something that puts him on one side or the other. But what comes next? Lacquer. All right, so you have Tarullo and Lacquer. Now, he's a huge hawk. All right, he's like the king hawk on the Fed. After that is Williams. Williams is, right over there the other way. So we have between 115 and 340, we have generally hawkish likelihood of the Fed, all right? So if you had to say this is like 50-50 right here, and this will be, we'll call that 100. So say it's 50, that's 100. So we have a 75% chance that there'll be some bearish Fed speak coming up in the next, right now, frankly. All right, so there is an actual catalyst, and there's a reason to say, well, let's short it down and see what happens. Maybe one of them will say something that spooks people. If they don't, get out. All right, so now, armed with that information, at 16,885, let's go short, and we'll go short again, because frankly, I can't stand making $5. $10, all right, $10 I can deal with, $10 a point. All right, now, I'm already saying this, so I'm happy to double down at around this range at 16,995. So I raised my, I'm planning with my two contracts now. I'm spending $10 a point. If it goes the other way, I will double down around here at 16,695. All right, but once it does that, I'll be committed to 4, and I'll be $20 a point loss. So I'm risking a loss of 25 times my $40, my 4 shares at $20 a share. So I'm risking a loss of $500 if it crosses back over 1620, because I'm planning to double down here. And if I double down here, my average will be, I think a little bit more. My average will be 1690. So I'll lose 30 times 20. I'll lose $600 if it pops out the wrong way. But if it goes up, but of course, obviously, if it goes up and comes back down off that 17 line, then I'm going to have 4 shares going down with the average of 1690. Or if it does what it's doing now, which is dropping directly down as soon as I make the trade practically, then everything's going according to plan. All right, and it's 75 bucks already. So I don't know what. If somebody could do me a favor, if somebody hears what they said, I would appreciate knowing that, because I really, it's kind of boring for me to sit here and look up the news while we're doing this. But that's it. That's my team. There's how I got a premise and how I use my knowledge of what the dynamics of the week are and the market dynamics to pick a spot and say, okay, if something bad's going to happen, then this is going to happen because something bad happened. And yes, as opposed to the FOMC release in 40 minutes. That's right. We should get that. We should certainly get out of this trade before the minutes release, because those are likely going to be the same dovish thing that boosted the market last time. I mean, what are they going to say? They're going to say free money, free money, free money. And then, of course, don't forget, Williams comes on. He's super dovish. He's coming on after those minutes, and he's going to spin it more dovish towards the close. So we have a good way to go long into the close, and for now, though, we can try short and see what happens. Not working out, then now it suddenly isn't working out, so it went from 75 bucks to 5 bucks. But obviously, don't react to every little twitch it does. So we'll see what happens. All right. So I don't know who said what, but something happened just then. I thought NTQE today. No, it's nothing like that. It was just the minutes of the last Fed meeting where they didn't do anything, basically. So, you just had to look at the Fed statement and figure out what's going on. All right. So let's see. Numb from watching CLF and XCO. Yeah, those are terrible, aren't they? You got CLF. Let's see. Boy, down and down they go, right? To CLF. And there's XCO. XCO is tragic, down to 250, but I like them at 250. In fact, I was just looking at one of our portfolios where we have it. I'm like, we should really get more of those. And I know it's hard, because you're like, oh, well, nobody else likes it. Why should I like it? Well, that's why you should like it. Look at this. If we had bought it at 250 here, and it would have gone up to 3, we would have made a quick 50 cents. And that would have taken 50 cents off our losses. That would have been nice. We could have gotten out and said, oh, we're happy with 50 cents. All right. The problem is a lot of times you forget to do that. People, you get into 250 and you get greedy and don't get out of the trade like you should. All right. So let's see. Mention you want to talk about hedges today. Good idea, Pat. Wow. Okay. Keeping me on track. Fantastic. Hedges. Okay. Let me get back to oil here just in case I forget what's going on. Oh, and by the way, so when you have one of these trades also, I'm going to watch the 1930 line. You want to keep an eye on, this is where I get in trouble, so I'm going to look away and it'll blow up on me. You want to watch the, let me just put my charts up on another screen so I have them too. Okay, you want to watch the 1930 line or any significant line like 1070 here. 1070 pops on the rut. I don't care whether this guy popped my level or not. I'm still going to get out. Oh, and he's doing a little triangle squeezy thing. See how that's working out? So he's squeezing, and he's going to pop one way or the other. All right, and he's actually, they're all doing it. He's squeezing too. I think everybody's flatlining. That's what's going on. People are starting to flatline into the Fed, into the minutes. So this might not work out as a good trade because everybody's sort of getting ready to do something, but they don't know what. Yep, that's a weird thing because the minutes are only going to elaborate on what we already know. There's nothing exciting about that. Let's see. Chrissy says, when you look at the futures grid and you calculate the high, low, and take 20 to 40% of that, I keep finding there's a 40% retrace, which you consider strong, then it continues down. Yeah. No, if you get a strong, do you have an example? Because I can show you. If you get a strong retrace and it fails, then that's bad. The point is there's 2 points at which you expect a retrace to occur. So in other words, okay, let's see. This is a short-term chart, so it's not the best thing to look at, but let's take a look. 15 minutes, okay. Here we go, great. That's actually a lovely number. So let me get Mr. Calculator because I tend to never get my math right when I do it out loud. All right. I can do it in my head just fine, but when I'm talking and doing, I always get the wrong numbers. All right, so 17,000, right? First of all, let's see if we have any serious lines. So 17,000 times 0.95. 16,150. All right, well, we're not there yet, so we're not worried about that. So it didn't fall 5%. So now we adjust that parameter. So you go 17,000 times 0.975. There you go. 16,575. Oh, that's so funny. Okay. So the 2.5% line on the Dow, and again, you know, when you get whole numbers, you round off to those. So when you get a line, especially look at how it came up here. Failed at the line, hit the line. A little bit over doesn't count. We don't count these in our trading. Look, you know, the spikes are interesting, but they're not the point. So we got the fall from 17,000. The 2.5% line is 16,575. So I wish this was thicker, but it's not. Okay. So you see, but anyway, so it's basically right there. It says 15,582. This thing almost exactly, and for the second time, look, here's the line also. See how well it obeys it? Last time, 2.5% drop, full recovery. This time, 2.5% drop. So what if there is not a full recovery this time? Then it's like a bouncing ball. You had a super ball, it did a nice bounce, now it comes down, but it's got less energy, and it's going to be harder for it to retrace. So without looking here, well, we have to, now that I said it, everybody's going to look there. Without looking there, though, if there's a drop of 2.5% from 17,000 to 16, well, let's call it 16.6. Let's ignore the 25. It's not that important. From 16.6 to 17,000 to 16.6. And how much is our bounce going to be? It's going to be 20% of the 400-point drop. The 400-point drop, so it's 80 points is your bounce. So my bounces are going to be 16,680. Oh, look where it is right now. So my bounces are going to be 16,680 and 16,160. So we're 16,760. So we're 16,760. Right there. That is your strong bounce. All right. So you see how that? See right here, this line going across the top here. That's your strong bounce line. And over here, here's your strong bounce line. So it became 16. Wait, let me get it. All right. So see 16,760. So here you go. You plow right through, and if you break through what would be the strong bounce line on the way down, you already know that it's probably going to complete your trend down to the 2.5% line. Then you come back, you make a strong bounce. All right, the weak bounce is 80, so 1680, that's your weak bounce. Flew right through that. Once it flies through the weak bounce, you're probably going to hit your strong bounce. Hit your strong bounce, but that becomes resistance, pulls back, shuttles around, breaks over the strong bounce, and then back all the way back up. So when that, when what you said is the strong retrace, when the strong retrace line breaks, that's a bullish signal. Okay, it's a bullish signal that the strong bounce. You can't bet the strong bounce to fail. It's just the point where you should be watching it and observing and seeing what happens. When you get over it, now you have a bullish trade, and that would be an easy bullish money up to here. Then you get back to this line. I would certainly bet that we did. Obviously, we bet with DXD, but I would certainly bet that that's going to fail. Chances are that's going to fail. Second time is not a charm in things like this, especially when the overall conditions are weak. We came back. You go back, and the only line we care about on the way back, I'm sorry, on the way up now, we still have these 80-point moves that are all significant in this 400-point trend now. So you have an 80-point move to what? 620. That's a weak retrace at 620. Okay, you see how that works? It breaks through it, comes down, comes back. And what's below 620? That would be 1840. Yeah, the next 80 points down. And what's 1840? Look at this, exactly almost. 1840, here's a little contention around 1840. That's, even though it's a little bouncy, it's still consolidating for a move down. It's hugging around that line. And you can see it's not enthusiastic at the strong retrace and therefore likely to fail. When it does fail, it's an excellent spot to make a short bet. You're probably going back down. You do go back down, and now what I expect, see now that we're the second time trying this here, I only expect a weak bounce. All right, I'd be surprised if there's a strong bounce, but if there was a strong bounce, I would bet heavily on a short there. But since we're at the weak bounce, and like I said, we had a premise that the Fed was, we're going to get some negative Fed speak right now, then it was a good reason to make a short bet. And here we are back to 85, yes. So don't say you didn't have a chance to enter. That was easy money. All right, and now, if I was a conservative bettor, which I am, frankly, I'm sorry, not long. I'm going to now sell one. What the hell just happened? No, I did it wrong. I was short. Oh, stupid. I can't believe I just did that. I just bought one instead of selling one. Stop. Oh my God, I can't get out of it. I don't know what. Something's wrong with this because it's stuck. What I meant to do was buy it back so that I would raise my basis on this trade, but now it's like stuck. All right, so let me get back to the questions, except I'm kind of annoyed about this. Is it just not filling? Cancel O orders. Oh, that's nice. You gotta be kidding me. Oh, did I get it? No. Sorry about that, but I actually am worried about the 2 o'clock Fed meeting. Oh, son of a bitch. We failed to, oh good, maybe that'll fix it. Yes, cancel 2 orders, please. Look at this. So it's treating it like a stop, right? Oh no, that was nice. So it's treating it like a stop. What the? This is not good, guys. I may have to reboot that. Click flatten. Oh, thank you. Good, freaking great idea. So close my position. Buy 100% of 3 things. No, I did not work at that. More orders. Cancel. Never seen this happen before. Cancel 1 order. How about now? Holy crap, that's a brand new one for me. Well, so this is the point where you normally, there you go, 1 off anyway. This is the point where you would call your broker and ask him, what the frick? It's not filling anything. This is what's annoying about it. I'm short 3 and it's going the other way and it won't fill anything. How could you fix something like this? Oh, wait, it wants something to fill. Look at this. I mean, I don't even know what the hell it is. This is moving with it. I'm so annoyed right now. Cancel 1 order. See, that one says cancel no orders. Oh, something happened. Now I'm short 2. But I have an order to buy 3 at market, which I do not want to do. Cancel that order. Ow. Ow. Cancel 2 orders. You gotta keep at the son of a bitch. Yeah, thanks. After you take all my money, you bastards. All right, you know what? I might actually be out of this thing. And it came out to 0. Oh my God! After all that hassle. All right, well, it came out to 0. Now I'll be pissed if it drops, but I'm not happy with what's going on there. All right. Yeah, I was gonna relaunch if it kept going. I wasn't gonna risk that into the Fed. That would be crazy. Wow, that was so funny. All right, so let's see, where were you? Now I'm going to a couple of questions. Okay, so yeah, there's a good one, Craig. So the Russell is down half a point, and the other guys are not, and that is a good reason to be long TNA or something like that, because you want to say if you're going to be long, if something good is going to happen at 2 o'clock, and you think the market's going to pop, and you've got Williams backing you up, so even if the 2 o'clock doesn't go well, at least Williams is going to come back and spin it later. You have a good reason to try to be bullish right into the meeting. So we were hoping for a little pullback here. It didn't happen. We got out of the position flat after much chagrin. And so now I'd be looking for an opportunity to go long. And you're right, going long the Russell seems like the best idea. And I guess it's worth it. Frankly, I would rather not. In fact, with a meeting in the minutes, I'd rather wait and see what they say. And then bet, because a lot of times people just go the wrong way anyway. So you say, hey, that's not as bearish as it sounds, and you bet the other way. Talking about hedges, we still want to talk about hedges, don't we? When you look at your futures grid and you calculate the high-low, we talked about that. All indexes are up except the Russell, and you usually like to say the laggard. Yeah, that's right. It will be long the Russell, but only long the Russell, though. It's not. You want to go long the Russell if you have a reason to go long. And then you would look for, like, who's lagging and who's likely to bounce. But it's also, again, it goes back to even if the S&P were lagging and I wanted to play it, I could play this 1930 line, but it really, as you can see, has very, very little support all the way down to here. It's this vicious dive before. So that's going to be very, very volatile. None of these guys are near any particular support. We'll take a look at the NASDAQ, because we're done with oil anyway. So take a look at the NASDAQ, which is NQ. Oh, look at that. See, now, here's a good line, though, because if the NASDAQ pops this line, and forget 69. The real line is 75 on the 5% rule. We'll be looking at the 75 line. But anyway, so here's a nice support resistance line. So if the NASDAQ pops this, then you start saying, well, maybe the other guys are going to pop too, but if the NASDAQ fails this, then maybe everybody's going to fail. You know, it's like who's at some significant line that you can keep your eye on. Now, the Dow is squeezing over the 85 mark that we were watching. And remember what I said, though? If we stayed on plan for being bearish, I wanted to double down here. If it hit 95, I wanted to double down to see. I'd have my average up at 90, and then we could try to make a little bit of money off of that. That was my game plan. But now, I imagine that both the Fed guys have had a chance to speak, and they haven't said anything too damaging because the market's obviously going up. And maybe they're going up because they're now relieved that nobody said anything bad, you know, especially Fisher. That he didn't say anything bad, or the latter, well, whoever is one of the bears, and he didn't say anything very bad, and therefore there's a relief going on right now. So you have a little bit of a relief rally, and that's why you got to pay attention. You can't just like guess. You have to say, well, what did he say? That's what's important. So, but we assume that there's a little bit of a relief rally because nothing bad got said, and now you've got the minutes, and of course the minutes already know. I mean, the people who are trading, they know what the minutes basically say. And obviously, it's going to say not much different than the Fed statement, right? The statement comes from a summary of the minutes. Because what they do is they have this meeting, they have all this discussion, they say, okay, so we're going to make a statement based on our discussion that says X. All right, they already said that. They said that weeks ago. All right, so this is just the minutes of that meeting to give you some coloration as to why they came out with that statement. So at this point, I'd be looking for the more bullish trade. So the bullish trade is if you get confirmation of the NASDAQ over the support line here. If it gets, frankly though, until it gets over 75, I'm not going to be that impressed with it. But then I would, so I need 75 here. That means I want to see the S&P over the 35 line. And if the S&P is over 35, then this guy should be over the Dow should be back over the 16,720 line. All right. So if those three things happen, then at that point, the Russell should be over the 1070 line, and if the Russell's over the 1070 line, therefore I can certainly go along the Russell, who would still be the laggard at 1070. Get it? So the official play heading into the minutes, providing these guys do what they, you know, when you see this line and this line and this line all pop, then you want to go long on the Russell as a laggard. And then if any of them break, you get out of the trade because your premise is low. But our premise bullishly is saying, and I could have a bearish premise saying the same thing, say if those lines fail, I want to go bearish. But I'm saying into the minutes, I think probably we get a bit of a pop. So not into them, I'm sorry, after the minutes. Into the minutes, who knows what's going to happen. So if this pops and this pops and that pops, then I expect the Russell to be lagging them at 1070. And then I've got a pretty clean shot for a 5-point gain on the Russell, which is not bad. It's $500. All right, that's how you play that setup. Now we were talking about, isn't that we usually play the lag? Yes, it did now. Okay. Yes. No. It's in the course of a day you can say yes. Trend-wise, there's small caps are weak and so on and so forth. But in reality, they're all these indexes. I always say, let's say they're like tugboats. All right. You think of the whole market and the big market, and often the S&P is like the indicator of the main market of the New York Stock Exchange. But the rest, all these indexes are like tugboats. They can go a certain distance away from each other, and I think usually the gap is no more than 10%. Like it's very, so figure they all have a 5% rope, attached to the boat. And you know how a tugboat works, right? Like 4 tugboats will pull this great big boat. So you've got all these indexes pulling the market in a certain direction. Now, at any given time, one of the boats can go left and one can go right and so on and so forth. But they're all attached to the great big boat by a giant rope. And if they all pull together, then the whole market, the whole big giant boat's going to go one way. If they all pull the other way, it's going to go the other way. But if they start going off in different directions, all right, neither one, if one goes way up, like the NASDAQ goes way up and the Russell goes way down, they both only can go so far before the rope starts to snap, and it's going to pull them back. So figure if the spread maxes out at around 10%, that if the Russell is 10% lower than the S&P, then something's got to give. At a certain point, you say, wow, one of those guys is going to either the Russell's going to bounce back up, or the NASDAQ's going to bounce back down. All right, that's what you have to think about. Like, and now, and it doesn't have to be 10. Don't fixate on the 10%. The point is that even in a given moment like this, if you see 3 of the indexes pulling in one direction, then the guy who hasn't pulled in that direction is probably going to start going that way. It's very hard not to go the same way. Over the long run, you'll get a bigger discrepancy up to 10%, like I said. But in the short run, you really don't get very much discrepancy on a daily basis. Like when something happens, they all kind of go the same way. So long TNA, very good play, Craig. In fact, TNA is not a hedge, but we'll say TNA would be an upside hedge. So if you're too bearish, it's a good hedge. Are you saying we shouldn't do that on a 5-minute? Well, let's see, Chrissy. You can. Frankly, the 5% rule with an index, it works better. The more liquid something is, the better it works. So you want to focus on things that are highly liquid, like an index or an ETF, or I used to do it with Exxon. I used to trade Exxon like all day long. I used to sit there and trade Exxon all day. Okay. So I would just play Exxon. Whenever it got into a channel, I would start trading the channel. It was so reliable, and you could watch oil, and Exxon would follow oil around. It used to be great to trade. Now it's not as good now, but it's still I can still probably trade it, but I just don't have the patience anymore now that I'm old. I've gotten less patient. Can't sit there and stare at one stupid stock all day. But anything where you find a channel, and here's what look at what we got. Look at this channel. It's a tradable channel. It's formed, and it behaves in the channel. So you play it until it breaks. And when I say play it until it breaks, where's the harm right now? If I was bearish, which we're not, but if I was bearish, why would I not want to play this channel? It's at the top of the channel. If it breaks over, you can magnify it and say what it is. If it breaks over, there you go. If it breaks over this line, so 16,934. If it breaks over 970, which is a very small loss, the NASDAQ is $20 a point, so you're talking about a $20 loss per contract. So if it breaks over that line, then you're going to dump the trade. Then your premise is wrong. So you short here, and if it goes over there, your premise is wrong. If it goes down, you start making money. And you've got the channel backing you up. But again, I don't like that because I think this is bullish at the moment. I think we're going to break over right now. But if you were going to short, there's a nice channel, and you play the channel until the channel breaks. There goes the channel. Now he's going to pop, and now the next guy we're expecting to pop is this one. All right, so we get ready for our close-up, right? And we do a little close-up here. So now we're expecting him to pop. Then we're expecting him to pop. And now, these are like dominoes, okay? One good. We're going to go check, check. It's like a get ready for liftoff, check. And that means he's going to go too. And the higher he goes, the more confident I'm going to get. 34, 03, I'm watching every tick. I want to see some, nope, lack of progress there. See, he could be wrong. He's one guy. He could be wrong. So it's 72, 34, 05, 06. Come on, you can do it, baby. 07, yes, it looks good. And he's 09. There it goes. Okay, I'm going to take it now. Oh, you kidding me. Thank you. All right. So now I felt brave because he hit 75. He's heading up, obviously, in a good trend. He's flying now. So now we got two reasons. So we're almost there. But now, if it fails, I'm watching very carefully now because if these guys end up failing, then I'm going to get out of this trade. I was kind of hoping I get a better entry and get a point. And we got 14 minutes until the Fed, so I'm certainly not going to buy a lot of these things. We can get killed with this thing. But at least I got some support here, so hopefully I wouldn't lose more than this, which is still, you know, $600, $700 down there. All right, so hopefully not. We got 935. Come on, he's doing well though. The Nasdaq is doing very well. And remember, I said 75 is my real number. So this is what counts. But if he gets over 75, I'm going to feel very good about this trade. A little bit over here. No Fed speaking until tomorrow. What? Am I wrong about that? Wasn't the wrong day? Uh-oh. Oh, I was. Holy crap. All right, so it's all about the minutes. Thank you. Thanks, Devin. Oh, son of a bitch. Okay, I'm sorry. I was looking at Thursday, and that's not. It's tomorrow we'll be looking at these guys speaking. Tomorrow we're going to have fun with this stuff. So it's not today. It's only now. We don't have any yelling or anything later. We only have the minutes coming out in 15 minutes. So it's all about the minutes and what they say. But since we already saw the meeting and we already got a bullish reaction off this statement, it's not that likely the minutes are going to say something bad. So we can give it a few minutes and we'll see what happens. Meanwhile, let's talk about hedging. Still, I like the SQQs, but frankly, I think we're going to bounce. I mean, I think we're good for a bounce today. So it's a tough day to talk about it. But let's take a look at what we do have for hedges in the FTP. Somebody please tell me if the market turns back down because I'd like to not sit there and lose money like an idiot. Where are we? Portfolios, right. Okay. So we can find it. Wow, that looks very zoomy, doesn't it? I wish that's where the income portfolio was. Let's be relogged. We took a big hit with GTAT. That really screwed us. Sudden bankruptcy. Unfortunately, we did what we usually do. You know, it went down. We added more. We put ourselves into a full position, and then the company fell off a cliff. All right, so that took a big dent on the long-term portfolio. We're down to 13.5. That's down from 20. So that's not good. We lost 1/3 of our profits in the long-term portfolio. Not just GTAT though. Everybody retraced a bit. But we're sitting on this big loss on GTAT. We already took a loss on the first set of short puts. That loss is banked, so it came out of the cash. And now we've got the new short puts, okay, and they're not improving or anything like that. And we got this call dead. It's really just sitting there. There's no point except that it's got a year, so you may as well leave it. So that's where we are with that. So what was I going to say? Hedges, right. So there's no hedges in the long-term portfolio. In the short-term portfolio, it's all about the hedges. And because it's all about the hedges, yay, thank God, it's up 71%. That's funny. Your mom says, ladies, oh, it's private. Don't do private. Say chat to all people. Because I'm glad I installed the seatbelt on my toilet. So anyway, so the bottom line is, now I don't know the math. 13%, 565. So we have about 565 in the other portfolio, plus 170 here. So we're up around 7. We're still up at 635. It's still not terrible. We're up more than 20% on the combined two. But unfortunately, it's just annoying because it's like the short-term portfolio is doing what it's supposed to do. It's protecting the long-term portfolio, but it'd be nice to make a gain. You know what I mean? It'd be nice to actually have a positive outcome at some point. It's been very frustrating for the last month where we've been sitting in just about the same 20% net gain between the two portfolios. But here's the thing. So what's going on in the short-term portfolio? We have layers of protection. So we first, let's look at the time frame. See 930. We started with SQQQ, and we went all the way out till January. Bought 3-month protection. We saw 930. Stock charts. Okay. SPX. Oh, that's so annoying. All right. So on 930 on SPX, what were we looking at? Here's the 30th, okay? So we were right here. We weren't sure if we were going to hold that 1975 line or fail it. We thought we were going to go down, and we just actually rolled out of some other, we picked up some money on some other short things. I think we had some DXDs that we cashed in. We weren't sure if these 50 DMAs were going to hold, but we said, well, if they don't, we're going to have a pretty big drop after the 50 DMA fails. So on 930, we added this trade. Oops. Where'd it go? Okay. So on the 30th, we added 40, which is a big chunk. We added 40 of the SQQ $7 spreads, 33, 40 bull call spreads, okay? So we're looking for a move of 20%, a little bit, 20% would be 660. So we're looking for a move of 20%, which would be, this is a ultra ETF, triple ETF, so that would be divide 20 by 7. So a 7% drop in the NASDAQ would give us 20% move in this ETF, and and that's how we would make our money. That's what we were looking for. How much was the money? We were pretty aggressive. This is a $2.40 spread when we took it, and what's the maximum payoff? It's $7. So you can make just a little bit less than 200% on this trade if it goes well. But you see, that's the point of a hedge, though, because we spent a net $10,000, right? And the upside on that trade is $28,000. So we have an $18,000 upside on that trade. And we're using that, it's $18,000 on a 6% drop in the NASDAQ. So the thing is, if the NASDAQ drops 6%, what are we going to lose in a long-term portfolio? So in a long-term portfolio, we already calculated that each 5% drop in the index cost us $25,000. We are basically in a long-term portfolio losing $5,000 per percent drop in the S&P, in the broader market. All right, so we know we're going to lose $25,000 in a 5% drop. So what does this do? We get $18,000 back from this spread. Now, if it doesn't drop and the long-term portfolio flatlines, we also know that we're going to make money because all of our hedges, all of our bets in the long-term portfolio are be the house kind of plays where we make money as long as the market doesn't fail. Obviously, not every stock, but as we just learned from GTAT, it's not foolproof because individual stocks can fail. But the overall strategy continues to bring money to us as long as the market doesn't drastically drop. Okay, so the stocks stay more or less in line, and we more or less make money as long as it's not drastic failure. So we're only playing here to hedge the drastic failure. And since the hedge pays off 3 to 1 on the downside, that's a pretty strong hedge. So it's paying me back 200%. If the NASDAQ drops 6%, that's a really strong payoff. Now, that's 930. 10-2, we decided to add more. We said, you know what, we don't have enough of these. And we decided to get more aggressive because the market looked weaker. Okay, so here we are on 930. We had a big plunge on 10-1 or something like that. Then we're looking here. We had this thing. And at some point along here, we decided that we were actually weaker, that we didn't think it was going to go higher. It did go higher, it bounced, so that's fine. And Now it came back down. So we got more aggressive, and we added, this is called layering. So we added another layer of protection. Oh, I'm sorry, in 10-1. So 10-1, we added these DXDs also for January, so we weren't that sure, but we did decide we needed more protection. And you do this by observing. So in other words, we observed the long-term portfolio as the market was dropping. We said, we don't have enough protection. We need more protection. I know, remember we had a conversation about that. So I said, we don't have, it's not, the combination of the two portfolios wasn't working well enough for us, and we didn't like the way it was going. So we decided that we need to be a little bit more leaning bearish. So it's like when you're surfing and you want to just adjust. You know, you make a little tiny adjustment left and right. You don't jump from one side of the board to the other. That doesn't work. You just lean a little one way, lean a little the other way. So we added more on the next. So one day we do this, not enough. Then we go like this and do these DXD spreads, $4 spreads, and we paid $1.44. All right. So again, it's also, notice how I keep going for those ratios. I like 2-to-1 payoffs. I like a play that gives you 2 times more than you get. So we got that one. So now we have 2 of them, and this one's also January. So then I decided, then the next day, still looking weak, so we decided to add a shorter term one because we want to be able to generate some quick cash. So we went to the SQQQ. This is a $5 SQQ spread. This one was net 250, so this one only makes 100%, but it makes 100% quickly. This one makes 200%, but it takes until January. This one makes 100% quickly. So we went. So that was our next play. Then, and by the way, because it's a bull call spread, I expect to maintain my value pretty well. So even if we're wrong, or even if it doesn't go down as much as we think, we still maintain most of this money, most of this 445 investment. I'm sorry, it's not 445, it's a net 250 investment. So we maintain most of the 250 investment, and until this goes below 250, it's not a loss. I'm just going to roll this out and add it to a longer term spread. So I'd probably roll these 50. I'm sorry, these are 30. They're currently valued at $11,000. So let's say if they drop down to like under $10,000, what I'm going to do is I'm going to take those and I'm going to use them to like double up a longer term position, like these 33. So I'd add 50% more to this one. So I would increase my hedge on the longer term, assuming, of course, we still want to hedge. The next one we added was more. We added more SQQQs, right? We said that. And that, oh, I'm sorry, then we added these too. Then we got, see, we were really worried into the weekend. Then we added these 50 naked DXDs. Oh, and these guys doubled up. We should really take these off the table. These are Octobers. We had 50 naked DXDs. Oh, all right, I'm calling that right now. We've got to get out of those. That's one to take the money off on. Oh, look at that. Forgot all about these guys. Very nice. $340 for one freaking thing. That's lovely. All right, well, that was worth it. And did we have the thing yet? No. See, now look, see, it's $340, and we haven't even had the minutes yet, so why should I stay in? Everything's going according to plan. If I bought 2, I would leave 1 or something like that, but boom, that's it. I'm done with my trade. I made $340 while we were talking. You see, you don't look at gift horse in the mouth. If you make a trade and it takes off in your direction right away and you make money before the event that you were betting on, why should I bet on the event then? I wasn't positive. All right. Now with DXD, let's officially take off that thing. So we're going to sell those. I'm going to take a look at what DXD really is trading for. And again, because it's an event coming up that I'm not sure of, and we already have a double. So why would I risk my double on an event where I don't know what's going to happen? If I knew what was going to happen, that would be the one thing, but I don't. October 24 calls. Okay, so we have the DXD October 24 calls, and it says that we can get 126, but I'd be happy with 120. So let's call it a sale for 120 and get out of this. All right, now verify later so we're right at 2 o'clock. So well, actually, you know what? We'll take 115 now. Whatever it is, I take it because I don't want to mess around. Because we don't know what the Fed's going to do. So now we'll see what the Fed does because we're going to watch the charts and we're going to pay attention to the news. Hang on, I'm going to hold my TV for a second so I can hear this. And we'll know from the reaction what they're doing anyway. Good, that's bullish. They're talking about how they're worried about global weakness. That is bullish. That means they're not likely to want to make a mistake that can overdo the tightening. I don't know if you can hear this. They think there's going to be low growth, low inflation, and poor housing. That means they're going to be pushing. So now I might want to even get back in these guys once they punch over 107.5. See, everybody's heading up now. Now watch. He goes over 140. That's a new line I can watch. 1940. He's over the 75 line. He's over, and now I want him to go over 650. These are going to be my next bullish lines, and he's going to be 75. I'd be looking for. So watch this. So now I'm going to check off. Again, it's the same thing every time, though. I want to check off my spots to make sure I'm not crazy. I want to see 1940. I want to see 1675. I want to see 30. Well, here I want to see basically 39.90. I want to see that line taken out. And then I want to see 1075 on the Russell. And I'm not missing much. I just made 340 bucks. So what do I'm not worried about if I don't make my 50 bucks between here and there. I want to make sure it's going in the right direction. And it is. So, oh, wow, look at that. All right, great. Now I got a line to play off of. Go a little bit lower. 41.75, 39.87, 16. No, not holding. See, I'm glad it didn't fill now. This is weird. You would think people would be more excited about it. Somebody's selling into this. So now I'm not happy. All right. So there's the Fed minutes. They're as dovish as you could possibly want them to be, and we're still not going up. That's not a very good sign, frankly. Now I'm no longer interested in playing the Russell. It didn't do what I thought it was going to do. All right, and so now, unless they get over that 107.6 line, I'm not going to be interested. If they come back down here, I might get interested again, but I'm not really playing it. So look, we see we didn't get the full confirmation. We didn't get this line here. We didn't. Well, we got 750 here, but look how poorly it's performing up there. And you can see the momentum slowing by the way the candle is. You see how the momentum stops and starts retracing on the candle. These are only 5-minute candles. We're not like, we're not asking for the world here. We're asking for it to be bullish for 5 whole minutes. All right, so that time it didn't work, but fortunately, that's why we entered over the 1050 line, the 1075 line. I tried to enter over the line. It didn't make it. It didn't even fill my order. It just failed and went back down. But that's fine. I'm like, good. Don't fill my order if you're not going to be going up. I didn't need to chase that one because I was waiting for it to go. If my theory was correct, it would have kept going higher. What good does it do me? What good does it do me if it can't make it over the 75 line? Then it's not worth it. All right, so now I got to wrap this up, unfortunately, because I got to run out of here shortly. I was wondering if you saw what this means. All right, remarketing for the first time on GTAT bankruptcy. We are focused on preserving jobs in Arizona. That doesn't mean anything. GTAT surprising decision will continue to work with the state, local officials, and next steps. Well, that's just what that's what you're saying. Bankruptcy. The remarks come ahead of tomorrow's morning bankruptcy hearing. That's the thing. What are they going to say at the bankruptcy hearing? We'll get the details and find out what actually happened here. Apple withheld $139 million prepayment, and that's what basically killed it. Well, it's interesting. So we'll see what happens. I mean, sometimes you go to bankruptcy court, you don't go bankrupt. It's very rare, but you can go to bankruptcy court and decide that you say, oh, you know what, Your Honor, we've worked it out with our, we worked it out with our creditors already, and we're okay. Because really, the whole issue in this case is Apple and their money. If Apple gives them the money, they're apparently viable. If Apple doesn't give them the money, they're not going to be viable. So, and then if they can't complete their factory and no one will lend them money, they're going to be totally screwed. So we will see what happens. But as I keep saying, it's very likely that we're going to lose the rest of our money. We've lost most of our money on GTAT. We're kind of holding on because we might not lose as much as we think, but the amount left to lose is so small that it doesn't matter anymore. That's the way we're playing GTAT, not very enthusiastically. How would you place a TZA spread today? Okay, we'll look at that in a moment. Free money I'm short. Oh, wait. Rich says, define bounce lines for oil, please. Define. Sure, but I shouldn't have to define them. I mean, you guys got to, it's not, all you're going to look for, well, I'm sorry, it takes practice. It does. I mean, this is what we teach. So, you know, I mean, always feel free to ask in chat every day, because we can always talk about that. First of all, you always want to look out far to see where your real bounce lines are. So oil fell from 95. There's the top of your range, 95. Okay, we don't know what the bottom of the range is, but we'll assume 87.50 is a thing. All right, so back to the calculator, and we'll say the first thing you do is this: 95 times 0.95, 90.25. Well, we're below that, so we know we're down more than 5%. What's 7.5%? That's 95 times 0.925. 87.87. Oh, well, there you go. Okay, so now we know where we are. We're at the 7.5% line. So we failed 5%, which I already forgot what it was. But we failed 5%, which is about 90.50 or something like that. So here's the 5% line. Look how it behaves. Let's try it again. 95 times 0.95, 9025. Okay. So here's 9025, and look how well that behaves. That's your 5% line. See how it did? Here's the 5% line holding up. Here, here, and here. It was holding up. You retest your high, but see that second retest? When you fail that second retest, it's not a good thing. And then, boom, it plunged straight down there. This one caught us by surprise. We weren't playing for this. We missed it. Fell straight down there like a rock. $4 in like a day. So it fell straight down like a rock, and we missed that one. Can't give us a little bounce. Then we started catching these coming down. But this one was caught us by surprise. I mean, we were not prepared for that fast of a drop. And then once it got down here, we stopped playing short because it was too low. It was like, wow, that's a big move. And it is a big move because this turns out to be the 7.5% line. All right, well, actually, this is the 7.5% line right down here. So the bottom of this, basically, is the 7.5% line. That's support, but it's not good support. We're going to complete that move, and that move completes to, dun, 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 $85. Well, not really 85. I mean, it's really 95 times 0.9. 85.50. Okay, so the official real number is 85.50. So I kept saying the target was 85, but in reality, 85.50 would be the right one. And 85.50 is right down here. So that's going to complete the fall of a 10% drop in oil. Now, a 10% drop in oil could easily have a 2.5% overshoot. So that's going to be another 250 down. So 82.50 it could spike down to. But around 85, I'm very interested in going long. And today we already went long. We picked up a USO spread. Let's see what that was. We already went long on USO, and now let me explain why we went long on USO. Here it is. Because we're at the 7.5% line. So you take the USO, we probably will get a bounce here. There's a lot of good reasons we can get a bounce. We're only going to January. It's not like we're taking immediate. I don't say we're going to bounce today. I don't know when the catalyst will be, but a million things could happen to send oil higher now. So we go for the January 32.34 bull call spread for $1. That pays 2 at 34, and USO is right about 33 now. Okay? And in fact, let's see. USO. So it's, USO. There you go, 32.96. So it's pretty much in the money. You know, it's a nice 4 cents out of the money for the dollar you're spending. So you have USO long at this spot with virtually no premium. That's a nice place to be in. Oh, now you're over 75, you bastard. So that trade makes 100% by January. And all oil has to do is just go up a little bit from here. Basically, we're betting it's going to go back over 90 by January. If it doesn't, we don't care, though, because your net on the spread is $1. But how much off USO January 32? See, we have a plan here because the USO January 32s are, oh, look, they're $2. See? Because we bought them for like $2.12. This is us. We bought them for like $2.12 and sold them for $1.15. So a little bit less than $1 for the spread. So we bought, so we buy them for $2.12. Our net is $1 though. So what's going to happen if USO goes the other way? What if it goes to 85? we're still going to have $1 left on these, okay? So if the USO drops, these things will come down to $1. What we're going to do is take our dollar, it's the same dollar we put into the spread. We're going to take it and we're going to roll it further out to like April or whatever, and we'll create another spread in April, but at a lower strike. And maybe a wider spread, and maybe a more aggressive spread. I don't know, but I'm just saying though that's the plan. In other words, if USO, so we think it's a good place to play forbearance here, but if we're wrong, we have so much leeway because we took a bull call spread, and it's going to take so long before the value of the $32 calls that we bought goes below the dollar net that we paid for them. And at any point that happens, all we got to do is take our dollar off the table. We're going to leave the naked long calls, of course, but then we're going to cover it with an aggressive spread back in April. So we're going to have all the way until April for oil to recover and make us some money. All right, so that's how we're going to play that one. It's going to be good. Let's see what else is going on. Some See this way, you can't look away. If you're going to play the futures, you got to pay attention because now it crossed over. Oh, we got all our signals. See how easy that was? Wait, we didn't get the NASDAQ back. NQ. There we go. Oh, not the hour chart, though. There we go. Now, see how all the signals crossed? He crossed. Wait, what? Weren't we playing for this one? We were, right? So he crossed and he crossed. Well, oh, no, it was 1940. That's right. So 1940 crossed and he crossed and he crossed, and that meant we go long on the laggard, which is the Russell, and up it goes. And that's all it takes. All we're doing is watching, and now we're in the channel. So now you want to see, will he get out of his channel, and will he get out of his channel? If they get out of their channel, then I could stay long on this guy, at least until 80. And remember that was our original play this morning? We thought it would go from 1070 to 1080. That was the channel we were looking for today for a bullish play. All right, so last thing, because I got to get out of here. I'm not supposed to be doing this. Cook said they want to preserve jobs. Oh, that's nice of him. Okay, well, that's a good sign. Hey. That's a really good sign. Cook said that. Apple's got all the look. Apple's got all the power in the world, right? They spend more money on toilet paper than GTAT needs. So I think probably if Apple wants to save them, they will be saved. And Apple, frankly, from a PR perspective, may just want to save them. Oh my God, the VIX just fell from 18 back to below 16. The dollar. Oh, look at this bullshit. The dollar plunged too. The dollar went. From 85.90, it's now 85.50. So the dollar fell like half a point. So this is what's spurring this rally right now. You've got a weaker dollar. You've got the VIX just went off the table down. So everybody's bullish again. Everything's bullish, and we're playing for bounce. It's a good thing we got rid of those DXDs. You see the point of that? What did we get rid of? We got rid of our unprotected ones. The unprotected calls that made 100%. There was no point in risking those into this thing. That's why we get out of it. We have plenty of protection on the spreads and the longer-term stuff in case it kept going down. It was no big deal. But why would we risk 100% gain on the DXT? That makes no sense. 81% of GTAT stock holders, maybe they can serve Apple. Yeah, I don't think it takes much convincing, though, because it's nothing. $160 million to Apple is literally, I don't even think it's a day sale. I mean, it can't be a day sale. They make $140 billion in sales a year. So essentially, they do $500 million a day. So they're selling $500 million a day at a 25% profit. So every single day, they make as much money as GTAT needs. So it's one day's earnings for Apple to do this. So somebody's playing hardball, whether it's GTAT playing hardball or Apple playing hardball. Somebody's playing hardball. Contracts get renegotiated, and maybe we get out of this thing. Oh my God, would that be funny though? Because we got aggressive with our short puts too, so we would make so much money if this thing actually popped back. But you never know. They could also go bankrupt tomorrow. It's a 50-50 thing. TZA. Did I say I was going to go with TZA? I guess I did, Chrissy. All right. All right, so fine. So for TZA, first things first. Why do I want TZA to be my hedge, though? So you keep saying TZA. That's why I keep rejecting this idea. TZA is not what I would hedge. I would hedge XQQ. We don't have any TZA hedges, and we don't have any TZA hedges because TZA already went way up. Look. I can't. In fact, this morning in the Morning Post, they said, let's get out of that one. It's done. It's over. All right? You want to go long, definitely go long on TNA. TNA. This is obviously long. It's not a hedge, but look at that. It's nice on the 60 line. That's a good support line. Look at that. Look how well that's held up. So you're on the 60 line. You have no particular resistance all the way back up to 70. All right, that's a beautiful way to go long. Look how well it's performed over here. All right, and so that's a good spot. And also look at the poor Russell. So the answer to TZA is I would not play TZA long right now. Look at the Russell, also right off that line. Here's 1080. It's a little below 1080, but a little bit below for like a day or two. That doesn't mean anything because in the grand scheme of things, it's just going to look like a tiny spike. The only thing is little spike, little spike, little spike. It's meaningless. You can't pay attention to those. And when you're watching the 5-minute charts, the daily charts, all these things look important. But when you zoom back to the weekly, look at all these things end in a spike. They always end in a spike to the bottom. Spike, 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 spike. That's a reverse signal. So this panic that you guys have when you see this kind of thing happening daily is only the spike. This is when you're supposed to be going long when this is happening, but you're staring at these short-term charts and you get freaked out by like a little move or a little tiny correction. It's not a big deal. And that's why I like to focus on the numbers. The numbers are is it a 2.5% drop? Is it a 5% drop? Is it a 10% drop? Every time you go past, when it's a 2% drop, that's very, very likely to happen. A 2.5%. When it's a 5% drop, that's likely to happen. When it's a 10% drop, that's not likely to happen. And a 20% drop is incredibly unlikely. All right, so the more the drop is, the more you want to say, geez, let's really think about this. Maybe there's a good floor we can play bullish off. All right, and again, I'm not gung-ho bullish. The world economy's got problems and so on and so forth, but I'm also saying this is probably a good spot if you want to start picking some longs, and we're going to do that. We're going to go over the buy list tomorrow. If you want to start picking some longs, this is the time to start picking some longs. There's a lot of good stocks out there that are cheap. So TZA, not the thing I would hedge. What do you hedge with? You hedge with the laggard, and the laggard is still SQQQ. It's still the NASDAQ. Oh, what I do? Because realistically, we did this in the Morning Post. This is what we talked about in the Morning Post somewhere. Because I did my multi-chart, and this is why I do the multi-chart. Christy, you're all over the place. So you're you want to have a hedge on TZA, and I say TNA, and you're like, okay, how about doing TNA? It's the complete opposite. You know, is your portfolio too bullish or too bearish? If your portfolio took a big hit in the last few days, the last thing you want to do is add an aggressive bullish spread. You're already aggressively bullish. You know, and the point is, if you don't want more pain and you're worried, then you got to look at something sensible like an SQQ spread. The SQQ spreads, though, obviously the ones we already have are fine. You know, the ones we have in our portfolio. So you look at the those in that portfolio. But looking at SQQ now, all right. Looking at SQQ now, it's way down here. It could easily see how it's just popping over this resistance line here. All right. Now, of course, support resistance don't mean anything on an ultra, really, because what matters is what the index is doing. So you got to look at QQQ, ETF that's following the NASDAQ. And what are they doing? Well, they had a teeny, tiny pullback. This is a 2.5% pullback here. So they just had their little tiny pullback. Doesn't mean much. I'm sorry, 4%. So this is 4%. From 100 down to here is 4%. All right? So, but that's, if you hold your 4% line, because what's a 4%? 4% is a weak bounce off 5%, right? So this is a weak bounce line from 5%. But if they turn at the weak bounce line, that's actually bullish. And then 98 is the 2.5% line. Forget the 50, but the 2.5% line is 97.50. So they popped over the 2.5% line. So really what they did here is they held the 2.5% line. 97.50 generally held up. It held up here. It held up here, and it's holding up here. The average of these guys is 97.50. All right, so this is all you've got here so far is a 2.5% drop. Now, what do you expect to go up from a 2.5% drop? You expect to go up 0.5%. Forget 1.2%. You expect to go up 0.5% from 97.50, and that's 98. So over 98 is a weak bounce. Over 98.50 is a strong bounce on SQQ. If it fails that, and obviously the 98 is super significant, If it fails to get over 98, then we're back to looking for a weak move down to 92. If it does get over 98, though, then this whole rally is probably, this whole drop is probably over, and we're going to start heading back up again. All right, but again, what happened today? Today we had the Fed. We expected a bounce today. I said in the morning post that we should bounce 1% today. I said that in the morning because it's following the 5% rule. I mean, I don't know. I don't want to read my whole post, but I mean, I know I said it. Blah, 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 blah. All right, trust me, I said it. So I didn't say it here. I said it in the member chat. Oh, I'm sorry. Here you go. I'm looking for a weak bounce going at 1% of 5% rule of 1%. Anything less than 1% will be a bearish sign today. So where are we right now? The indexes are all up 1%, bouncing off the Fed statement. This is what we said would happen. This doesn't mean we're bullish. All right, I'm just saying I like TNA. If I'm going to play a bullish thing, I would play a TNA spread. I would, though, if I'm going to be bearish, I would still play the Qs because they still have a nasty drop ahead of them. And what SQQ? I would go with January because I'm not sure. I don't know what's going to happen. And if I'm going to look for a spread, I'm going to look for a spread that has a 2-to-1 risk-reward ratio in January, SQQQ. So I'm going to look for, in January, we're at 36. I prefer to be a bit in the money. That spread is ridiculously wide. Wow, these are all ridiculously wide. All right, I guess we'll have to take this one. No, 40 is no good. This is terrible. All right, well, I guess I'll go by this. So the last trade here was 523, all right, on the 35, and the 40. So it's the same spread we ended up doing in the short-term portfolio. And the 40s are 330. So basically, you're going to pay $2, or a little bit less than $2, hopefully, for so figure 190, 180. So you pay like about 190. For the $5 spread. So your upside is $3 off of $2. So it's 150% upside if SQQ goes up. But since you're paying net 190, you're only paying the exact amount of that now. You're going to make every penny of upside from there. That's how you construct a hedge. And if I was doing TNA, I'd do the same thing, looking for a bullish on TNA. But like I said, I think this is just the weak bounce we expected. All this 1% rally today, as impressive as it seems to get a 1% rally, it's the exact weak bounce we expected. I said 1080 this morning. It's what we thought was going to happen. Look at the NASDAQ. So the NASDAQ is outperforming to the upside, as it's been generally. And so let it run. I wouldn't start shorting it now. Let's see how it goes. We don't have any bearish thing happening until now we go back to the Fed. I mean, basically, we predicted everything that's happening now we knew was going to happen on Monday. Because we knew what we could see the plan for the week. Hawk, hawk, dove, dove, hawk, dove, hawk, dove, hawk, 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 hawk. Now, that hawk, hawk, hawk on Friday is going to kill you. So I damn sure want to have a hedge on the weekend, all right? So, but for now, let it go up. And Bullard is our first speaker tomorrow, okay? And Bullard is he's kind of a hawk. Yeah, he's basically hawkish. So he's the first guy. He's out of the box tomorrow morning. You're going to get a hawkish statement. So it's a tough call. I'm not really looking to alter anything we did. I'm glad we took those DXDs off when we did because we avoided a 1% hit going the other way. But now we're going to have a hawkish Bullard. Then comes Tarullo, okay, who's also a bit hawkish. Then you got Lacker, who's insanely hawkish, okay. Then you got Williams, whoop, now we fly the other way. All of a sudden Williams says, no, 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 they're all crazy. He gets the last, and they don't do this by accident, they do this on purpose. He gets the last word. They're going to say stuff that's going to worry people, and then he's going to come in. Oh, Draghi, oh my God, Draghi speaks too. Okay, so there's a dove. I missed that one. There's a surprise dove. We have, when Draghi speaks. Then we have the Bank of Japan minutes, but the Bank of Japan is going to be worried about easing, so that's hawkish too. It's a little concerning. That might be why they scheduled Williams here, because they want to get a positive spin into the Bank of Japan, who's going to be talking about not, going so easy on their money supply. And then here we got hawk, hawk, hawk. So this is all negative. If you're going to hedge, if you were worried about your drop, that STQ trade is probably something you want to pick up into today's close. So let the NASDAQ move up and then find yourself a hedge and grab something. I like that January SQQ spread. All right, so there we go. That was all fun and games. I enjoyed that. I made a little bit of money this time, so I'm not so upset. And where are we? So, oh my God, if I stuck with that, it was $1,000 if I'd stuck with that one. Oh well. See now, and now you watch this 1950 line. Obviously, the 4,000 line is very safe right now. All these lines are safe. So at this point, you can play again. Oh, well, over 1980, it's flying. So look, we're flying up now. So now you can watch this line here. It's not a good line, but as long as 1950 goes, in fact, 1950 is probably the best line to play at the moment. But that's all you do. You just find yourself a setup and play the setup and play it until it fails. But don't just play the one thing. You got to look at the other guys and see how they're doing and see if they're doing the same thing. Look at this move. Holy cow. This is what the Fed does to the markets. Look at that. That is fantastic, right? Nothing like having a friend like that. Okay, guys. Well, thank you so much for coming to the seminar this week, whatever. I'm sorry it was late today. We're going to do it on the regular time on Tuesday next week. And thanks all for coming. Appreciate it. Bye.